Right, folks, let's talk about trust and estates. These two things sounds really scary because it's so complex. And you know what? From tax point of view, if one thing is really complex, you know what? That most of the time is good for you because one side is complexity, the other side is the flexibility. If one thing's really complex, that means that you got more flexibility of that thing. That's from my personal experience. So you know what? Complexity is good. And you know what? You got me, so let me explain this to you. So basically, all these explanations involve how income is taxed. Whether it's trust or estates, you know what? Things we are going to worry about tax. Tax is basically, you have to distribute some of the income to IRS, right? To the Uncle Sam. So you know what? Just worry about how income is taxed. And let's look at the big picture here. So, whether it's trust or estates, trust you may, set up the trust, or estates, for example, someone passed away, then they leave estates. You know what? Under these two scenarios, trust and estates are separate tax entities. So that means you intentionally or unintentionally, because if someone passed away, that must be they're unintentionally passed away. But yeah, of course, someone may expecting that. We're not talking philosophical about it, right? We're purely focused on the tax point of view. So basically, if you want to separate some of the assets from you and make that a unique entity, and then it's a complete separation from you, and when it comes to tax, that basically these two is a great vehicle for that. Okay? So the big picture is something like this. Whether it's a trust or estate, they're not as the same person or entity or vehicle as the person who creates them. Okay? Whether you leave behind estate or whether you create trust, they're separate. But there's sort of fine print here. So if you say the trust, you create the trust, but the beneficiary is yourself, okay? Or there are some, trust can get really complex. But I just to give you some of the scenario. So if you use some of the, laws and decrees, something like that, you put that in the documentation inside of trust, right? You hire a lawyer to do that, but in the end, the beneficiary is in fact you, and you can control it. You know what? That is not separation. We're talking about the beneficiary is not you circumstances. Okay, there are a lot of fine print here, which we are going to make multiple videos to dive deeper, especially trust and estates. This is like a two really huge, two separate, huge, tangled words. We're going to go through this. It will be really, really fun journey. And you know what? When you actually practice the law, the tax, the finance, you're going to, especially if you dealing with the ultra high net worth client, you're going to dealing with this a lot. Okay, but don't worry about that. You got me. So let's go through this. So, as I said, they are like their own tax entities. So they're sort of it's a separation, generally speaking. Of course, there are exceptions. And that entity, as a unique entity, they file their own tax return. Okay, so just imagine they're like a company, they're organization, they're like another person, right? They file their own tax returns. And they follow their own tax rules that is maybe hugely different from you. And of course, when I mean huge different from you, for example, the tax bracket, that you and the trust, the estate, the tax bracket can be hugely different. Okay? So they got their own tax rules. So you can sort of treat this as a container. Okay? The trust or estate as a container of money, of all this liquid or illiquid assets. A strategic container here. And then containers doing their own tech thing. Okay, so let's dive first to trust.